go live. So I'll just give you a cue in a minute so that you can start. We are live now. You can start.
Good evening, everyone. Warm welcome to all the participants joining in for this session. My name is Amit Fulwani. I'm a partner in the Financial Services Tax team here in KPMG. For this particular session, I'm joined by my colleagues, Ashish Gupta, who is from the Individual Taxation team, Shreya Tripathi, who's from Indirect Taxation, and Naveen Gupta, who's from the Corporate Tax team. So as you know, we had the budget announcements earlier this morning. So this is the election year, and this is the kind of full budget for this particular year. This is after the interim budget, which we had in February, which was kind of announced for 4 months, considering the elections. In terms of the format for this particular session, what we intend to cover is touch upon some key announcements in different areas. Maybe to begin with, I can go with individual taxation, considering the audience for this particular session. I'm sure there'll be a lot of queries related to what is the impact on individuals pursuant to the announcements which have been made. So with that, I'll invite my colleague Ashish to touch upon some of the proposals which have been made today.
Thanks, Amit. I think you rightly mentioned that this is a full budget after the interim budget, which happened in January last year. Now, some of the key changes which have been brought in from an individual perspective, or rather, I should put it that there have been quite a few changes, more from a beneficial perspective on an individual taxation front, though there are one or two dampeners as well. So I'll take you through what are the key changes. The first one and the foremost one is a change with respect to the slab rates. There has been relaxation in slab rates, resulting in reduction of taxes. But the key thing to be noted is that whatever changes have been there, those are under the new tax regime. And if you are under an old tax regime, there is absolutely no change which has come in. Under the new tax regime, where you are not allowed certain deductions, etc. So under the new tax regime, the new tax slab rates would be up to 3 lakh, it will be nil. Up to 3 lakh to 6 lakh, it will be 5%. Then up to 9 lakh, it will be 10%. Then up to 12 lakh, 15%. And then up to 15 lakh, it is 20%. Then above 15 lakh, it will be 30%. There would be no change in any rebate, surcharge, or education cess. So that's something which is a key change which has been brought in. So the change that has come in is there is an increase of a lakh rupee in each and every slab rate, which is up to so the earlier regime, as I mentioned, was 3 to 6 lakh 5%. Now it has been increased from 3 to 7 lakh up to 5%. From 7 to 10 lakh, it is 10%, and 10 to 12 lakh, it is 15%. And then 12 lakh to 15 lakh, it is 20%. And then above that is 30%. There's a change in standard deduction as well. So standard deduction has been enhanced from 50,000 to 75,000. So this is available in case of individuals earning salaried income. So that's again a welcome step, because that will benefit a lot of individual salary taxpayers. There has been another significant benefit which has been offered by the government is in respect of contribution to the National Pension Scheme. The contribution has been enhanced from 10% to 14% of salary, even for a private sector employees. So earlier, the government sector employees were allowed to contribute up to 14% to the National Pension Scheme. So that has been now extended to even private sector employees. And parallelly, even the taxation benefit has been enhanced. So the deduction available under 80 CCD is up to 14%. But again, we need to remember that this deduction is with respect to new tax regime. It is not with respect to old tax regime. There has been an enhancement in the deduction with respect to pension. Earlier, the deduction was allowable up to 1/3 salary or 15,000, whichever is higher. Now that has been increased to 25,000. So that's another significant change which is benefiting, which is going to benefit large number of individuals earning the pension income. There have been certain changes with respect to capital gains, which because this will be affecting corporates as well. My colleague Naveen would be taking up on those changes. But broadly speaking, the short-term capital gains on the shares, which was 15% till now, will get enhanced to 20%, whereas the long-term capital gains which was there at 10% currently on the shares would get enhanced to 12.5%. But this 12.5% would be applicable to all kinds of long-term capital gains. And even the holding period for determining long-term capital gain has been reduced from 3 years to 2 years. The nitty-gritties would be covered by Naveen while he's covering the corporate tax proposals. Some of the other benefits which government has brought in is in respect of certain cash flow issues, because earlier if there were any TCS which was deducted on LRS payments or otherwise, the same was not allowed to be adjusted against the TDS on account of salary. And it was always a situation that if the entire salary is taxed, then this TCS was required to be recovered or claimed as a refund in the return of income, which typically used to result in cash flow issues for the individuals. So now they have provided for allowing TCS as well as TDS credits while uh, computing the TDS on salary income. So this is a very welcome move, because this would clearly result in better cash flow in the hands of salaried individuals. Another good thing that they have done is the TCS in the hands of minor would be allowed in the hands of parents, so that credit would be allowed. And this is just more of a correction, because uh, the income in any case is getting clubbed with one of the parent. But however, the TCS was not getting clubbed and was not getting automatically allowed. So that has been clarified, and again a welcome move, so that there is no refund situation which is coming in the hands of minor, etc. Another important one is with respect to black money disclosures. So effectively, in the return of income, we are required to disclose all specified foreign assets, and these foreign assets have to be disclosed without any threshold limit. And many a times, employees who had worked outside India and would have gained some stock options or would have contributed to social security outside India, many a times while filing their return, they inadvertently miss out on disclosing those assets in the foreign asset schedule, and which may result in the penalties coming under Black Money Act. So to provide some relief to those individuals, the law has been amended to uh, avoid penalty if the aggregate value of such assets which have not been disclosed is under 20 lakh rupees. So if it is under 20 lakh, if you missed out on reporting on that, then no penalty would be levied. So earlier, this benefit was applicable only for certain foreign bank accounts where the aggregate balance was less than 5 lakh rupees. So this is again a big welcome move for people who have been working outside India, maybe for shorter durations, etc. And many a times they would have missed out on reporting of some of these benefits. So these were some of the key changes which have come in from a personal taxation front. And I'll stop here, and maybe Amit, you can take the
Yeah.
session forward from here.
Thanks, Ashish. So looks like a whole host of changes which will be relevant for individuals. Not least is the one relating to capital markets. Looks like a fair bit of changes there with the amendments to the base rate, which has gone up for long term, let's say from 10 to 12.5%, and for short term from 15 to 20%. I think there's also some corresponding change in the STT rates, probably an attempt by the government to curb the kind of speculation activity. Maybe I'll go to Naveen now to give us a flavor of what are the changes which have been announced on the corporate tax front. Over to you, Naveen.
Yeah, thanks, Amit. So let me start by laying down some of the changes which have been made for non-residents. The applicable tax rate for non-resident taxpayers is proposed to be reduced from 43% to 35%. So therefore, this is a welcome change. The second is many companies do buyback and then make payment to the shareholders. Now, in that case, that has been attracting a buyback tax of 23.3% with effect from 1st October 2024. This is proposed to be changed because the government is of the view that this is akin to dividend payments. So henceforth, buyback considerations will become taxable as dividend income. And whatever is the cost of acquisition of such shares, that will be available for set off against future capital gains income. So that was second. Another provision is the equalization levy on online sale or provision of goods is now proposed to be withdrawn with effect from 1st August 2024. So this is a welcome change, and I'm sure it will bring good sigh of relief to non-resident players. Now, coming on to the domestic front, there are some measures proposed in this budget for reducing tax litigation. Now, one such provision is that there are monetary limits specified for permitting Income Tax Department to file appeal to the Tribunal, High Court, and Supreme Court. Now, these are proposed to be increased from 60 lakh rupees or 1 crore rupees and 2 crore rupees for the Tribunal, High Court, and Supreme Court cases to 60 lakh rupees, 2 crore rupees, and 5 crore rupees going forward. Then in addition to this, the scope of safe harbor provisions is proposed to be expanded so that it will become more appealing to the taxpayer community. Now, in addition to this, the transfer pricing assessment procedures are also proposed to be streamlined. Now, the details of it are still awaited and we'll get to see in the times to come. Now, another important point is the reassessment provisions by which tax authorities can reopen the past concluded cases. That time limit is proposed to be reduced from 10 assessment years to 5 assessment years with effect from 1st October 2024. So this is a welcome change which will bring more certainty to the taxpayers. Now, in addition to this, there are a number of changes on the TDS front where there are various provisions where the TDS rates have been prescribed. The government has proposed to reduce those TDS rates from 5% to 2% in 7 of such cases. These include the commission payments, rent payments by individual or HUF where the monthly rent payment is 50,000 or more, and similar other cases. Then on TDS on e-commerce operators, that is proposed to be reduced from 1% to 0.1%. Now, in addition, if a partnership firm pays salary, interest on capital, or bonus to its partners, then TDS rate of 10% will now start applying on such payments with effect from this year. So there are a number of changes on the TDS front, and some of them also pertaining to TDS scrutiny, where Indian company makes payments to non-resident players. There was no time limit specified under the Indian tax law by which tax authorities can reopen the case and go back. So now a time limit of 7 years is specified for conducting such scrutiny. Now, another very important point is that the TDS default, if there is a delay in payment of TDS, then it attracts prosecution provisions. Now, that is proposed to be decriminalized, provided the delay in payment of TDS is limited up to the date of filing TDS return. So now after TDS, there are some other provisions as well. So for example, if there is a tax withholding done in a foreign country, then that should form part of the total income of the Indian company. Then there are provisions for the liaison officers to furnish annual statement within 60 days from the close of the financial year, and else there are penalties of rupees 1,000 rupees per day for default is proposed to be legislated. And then in case income tax departments withholds your refund because they are conducting your audit or assessment, then they will not pay you any additional interest of 3% per annum for the period for which such refund is withheld. Well, there are some other provisions, but I think in the interest of time, maybe I will limit myself to this and hand it over back to Amit.
Thanks, Naveen. So looks like a lot of changes across sectors, and attendees will do well to kind of go through them and properly analyze the implications as we move ahead. So while we are on direct taxes, let me quickly come to Rashmin. So Rashmin is from our deals and M&A team. Let's hear from Rashmin. What are the kind of proposals relating to mergers and acquisitions? Over to you, Rashmin.
Yeah, thanks, Amit. So I will start with some of the welcome changes in this budget, quite a few, in fact. And I would say the first one is the major one on the removal of angel tax. I think this has been a talk of our town in terms of people facing a lot of assessment and litigation around the infusions coming in India, and there was some definitely affecting the sentiments of the investor community. I think there were a lot of representations about this topic, and fortunately, the ministry has considered this, and the government has come up with a blanket abolition of angel tax with effect from April 2024. So this will give a lot of certainty to investors who are infusing money in unicorns, startups, and a lot of Indian companies with certainty that at least on the infusions coming into the company, there should not be any tax go forward. The second point is about the capital gains computation for offer for sale happening during the IPO time. So if we remember that when they brought long-term capital gains to tax for listed shares, they also provided certain mechanism to compute your cost of acquisition. And they also provided a certain step up in terms of the market value as on particular date, which was Jan 31st, 2018. But there was no clarity in terms of for shares which people typically sell in offer for sale, what will be their cost of acquisition? So how their cost of acquisition will be computed for computing the long-term capital gains. So people were taking different views around that. The extremes which were taken were that the cost is not determinable and hence no capital gains. There were other line of thoughts also in terms of how to compute that capital gains. I think government has taken a note of that. And in the memorandum, they have clearly called out that to put to rest all those interpretation, they want to define how the cost of acquisition needs to be computed. So the way it is now clearly defined is you have to look at your actual cost of acquisition, and you will only get it indexed from your year in which you have acquired those shares till FY 27-2018. So you only get a particular period up to which those shares will get indexed. And there's a clarity in terms of how the cost will be computed. So this is, while it is defined, it comes as a little surprise that this particular amendment has been done retrospectively. So it is applicable from almost FY 18-19 kind of situation. So this puts a lot of people under pressure in terms of the positions which they would have taken for the transactions they would have taken in last 3-4 years. And how do they reconcile that position? So that's going to be a interesting area go forward now in terms of the past position taken. For this particular computation of cost, there are still gray area prevailing in terms of when companies do mergers, demergers. Listed companies typically do this restructuring for various objectives. So how those shares cost will be computed, it was anticipated that that also would be clarified. However, somehow maybe looks like government has kept it for the next budget. It is not in this budget, at least as we see. The third welcome, what I would say, while one of our colleagues talked about it, but this entire rationalization of your capital gains structure. So as resident sellers, be it be founders, be it be promoters of listed companies, they used to always think that non-residents are paying only 10% tax on long-term capital gains, but they were paying 20% tax on it. Now they have harmonized that with the residents. So for all long-term capital gains, whether it is a gain of a resident or a non-resident, the rate is 12.5% generally. So that gives a very good comfort to the Indian founders, promoters, that they are at parity with the non-residents when it comes to their exits. So that's a good move from the Indian founders' perspective. I think non-residents are marginally impacted because while their rate of capital gains has been increased from 10% to 12.5%, it appears that they may still continue to have the benefit of the forex capital gains computation. So with that, the increase is not that significant. So this entire change on capital gains rationalization in terms of period of holding and the rate of tax is a welcome move for the overall investment fraternity. Certainly for a fraternity which was more looking at the arbitrage of rate, the rate has increased by 2.5%. So that's a change which market is going to view a little differently. I think in terms of certain rationalization or anti-avoidance amendment, so there is an exemption under Section 47 which provides for gifts to be exempt. So it's a gift or a contribution to a trust. All of them are exempt from capital gains in the hands of transferor entities. It appears that that particular exemption was somewhere used in a different context, and there were corporate gifts which were done. And I think there were case laws which were on both the sides. I think government realized that this controversy also needs to put to bed. And the amendment has been clearly made to call out that the gifts could be only made when there is love and affection. So it will be restricted only to a gift by an individual or HUF. So this implies that all the corporate gifts go forward would not be exempt and they will be subject to capital gains. So it's a anti-avoidance amendment, so to say, and it will also give clarity in terms of the way gifts would happen. I think the last point I will talk about is this entire period rationalization on the reassessment point. I think Naveen touched upon that. But in terms of the deal scenario, if you look at the international landscape, so if you look at US or UK, they have typically their tax audit period of 2 or 3 years, and they call it as a look back period. Look back is our equivalent of reassessment. Their look back is around 5 to 6 years. Whereas we originally had a look back of 7 years, and some 2-3 years before that look back was extended to almost 10 to 11 years. I think that had put us as a country in a very different spot in terms of such an extended period of reassessment timelines. And when we are looking at investors, whether it's private equity or strategic, when they exit or they do a transaction, a look back period of 10 to 11 years definitely puts them into a difficult situation, because that implies that they would be probably called upon to indemnify certain things even after 10 to 11 years. So this amendment about, I would say calibrating the look back period or a reassessment period only up to 5 years now is a very important move. And I think the entire investment like the cycle and the fraternity of investment is going to appreciate that. I think Naveen also briefly touched upon the fact that historically there was never a time limit for the reassessment of tax withholding. That was also giving a lot of uncertainty when people were doing transactions where the sellers were getting a benefit of treaty and buyers were sometimes giving a benefit of non-withholding because the treaty benefit was made available to the sellers. But there was no clarity in terms of up to what period that withholding could be challenged, the non-withholding position or whatever on that part. Now, there is absolute clarity that the TDS reassess, the proceedings could be only upon up to 6 years. So that also is a welcome move in terms of this entire deal impact. So I would say, to summarize, this budget has given more of stability and clarity in terms of the investors and harmonization of tax rates for the capital gains. So overall, a good budget in terms of those measures. Back to you, Amit.
Yeah, thanks, Ashwin, for those insights on the various proposals related to deal making. In the interest of time, let me quickly go to Shreya and kind of hear about the proposals relating to indirect taxes. Over to you, Shreya.
Sure. Thanks, Amit. Good evening, everyone. So, you know how it is with GST, and now, from the last, since GST has been implemented, most of the changes are announced sort of before the budget through the GST Council meeting. So there's not that much, of a surprise element with the budget proposals. But yes, some two very important announcements today have been around simplification of the rate structure. So it looks like, there will be some rationalization around GST rates. We'll have to look out for that. Nothing has been specifically around, laid down on that. And also, the FM in the speech specifically mentioned that GST would now expand to, other sectors as well. While, the thought is, petrol, diesel, while there's some time for that to be, talked about, its inclusion to be, considered. But right away, a lot of other aspects come to mind, like electricity, aviation turbine fuel. These are sort of aspects that can be included in GST, and that will really cause an impact, because these sectors have sort of been outside of GST. And let's see what happens around that. As we were just speaking of the look back period in GST, there's been a change in the look back period. So far, there were always, two sections, Section 73 and Section 74, which basically talked about the limitation period before which a notice can be issued. So now going forward from FY 24-25, it's been announced that there'll be no two separate sections. There'll be one merged section under which, notices would be issued. So somewhere it was 3 years under Section 73. It was 5 years under Section 74, which dealt with fraud and, suppression related cases. Going forward, from this year onwards, it's basically going to be a section which will look to sort of issue notices within a period of 3.5 years, so 42 months, and to which the order will be issued in a year's time. Now, so therefore there will be a common time limit. Now, this is going to be, quite useful, because the industry has really suffered under this. Another important change is the amnesty under GST. So now this was announced in the GST Council meet as well, that there will be an amnesty, which will be announced in the budget proposals. So this amnesty is basically going to be issued for all notices that have been issued for FY 18, 19, and 20. So the initial 3 years of GST implementation, wherever the notices were issued under Section 73. So they've excluded all those notices which were issued for cases of fraud and suppression. So only simpliciter Section 73 cases. And this amnesty basically requires the taxpayer to pay full taxes. While the date is not out yet, but as the council had indicated, likely this will be around March of 25. So if all taxes have been paid for all these 3 years that I just spoke about, then there'll be a full waiver of interest and penalty. So this is, much welcome, and there have been a lot of, disputes piling up in GST as well. So this should help in alleviating some of those issues. While the amnesty scheme could have been, expanded to include other sections as well. However, this is quite beneficial for now. Separately, another important change which will help everyone is that when a summon is issued under Section 70, it wasn't yet clarified in the law that an authorized representative can attend on behalf of the person who's been summoned. And with the increasing investigations, now there's been a specific amendment to this, where the authorized representative can now appear on behalf of the summoned person. This is also a very, very, much welcome measure, because a lot of times, there have been issues related to availability, etc. So this should help in that regard. On the customs front, there has been a specific announcement that the duty rate rationalization will take place in a detailed manner. A 6-month window has been provided for carrying out this rate review, and this is really going to help in, easing trade, removal of duty inversions. The FM specifically mentioned that duty inversion is going to be corrected in the affected sectors. And there have been tweaks around duty rates for various sectors already, like mobile phones, telecom, energy, amongst others. Specifically on mobile phones, it's going to make imported mobile phones a lot much cheaper now. So that's going to be something good, to look forward to. I think that's about it from a GST and customs perspective. Back to you, Amit.
Thanks, Shreya. So if I may take a minute on proposals related to financial services, some of it has been covered, but I think one particular proposal which is of note is relating to change in the tax rates. So foreign banks and foreign reinsurance companies have historically been taxed at the rate of 43%, and there's been a long-standing demand to revisit the rate and bring it down to a reasonable level. So they have got part relief. It has been brought down to 38%. We heard some of the other proposals related to capital gains, which impacts mutual fund industry, as well as WITs and InvITs. So a lot of relevant changes which will have to be kind of factored in by the attendees. Maybe in the interest of time, we just have a minute or two left. I'll just kind of put a question to all the panelists and in no particular order, and please restrict your answers to not more than 20-30 seconds. If there's one announcement which you would want the FM to revisit in your particular segment, what would that be? Anyone can have a go?
I would say the buyback of shares. I think that is kind of the intention of this amendment was to rationalize some of the measures which was there, but it is kind of misfiring in terms of the implication of that, because dividend has to be always to the extent of only profits. The amendment says that whatever amount you pay on buyback of shares, irrespective of your profits of the company, the whole amount is going to get treated as dividend. And the tax is going to be paid on that. The entire cost is only available as loss, and people may not have loss to offset. So that's a big one to, I would say, look after. Yeah.
Okay, another one I'd like to highlight is on the indexation for long-term benefits, at least from a property transactions and all, some kind of an indexation should be allowed, because people who are holding really old assets, say because the valuations would be from 1st April, so 1st April 2001, if people are holding assets beyond that, then they probably would be in a significant loss situation from a taxation point of view. So I think there should be some indexation benefit provided from a long-term capital gain perspective.
Right. Thank you so much to all the panelists. We have run out of time, unfortunately. It was a short session. Idea was to give all the attendees a flavor of the announcements. So with that, thank you once again to all the panelists and all the attendees. We hope you found the session useful. Thank you so much.